That's how you should look at investments. Really, it's an asset.
Yeah.
You go see a TV, it was retailing for 80,000, then it's a flash sale. They cut it down to 32,000.
Yeah.
I mean, some of us, including myself, I think if I'm not liquid enough,
Yeah.
I'll go look for a soft loan and get
Yeah.
a TV.
Yeah.
In as much as I'm not a TV person, because of that value proposition.
Yeah.
And when you come into the stock market, that's what sophisticated investors do.
Mm-hmm.
They look at a company, case in study, the bank you're talking about earlier,
Yeah.
trading at a book value of 0.4, 0.5, 60% cheaper than
Yeah.
it's actually worth. That's a really, really good deal. There's something we call value trap, where you get something that is giving you a very good discount,
Yeah.
but then unlocking it becomes the issue.
Mhm.
And if you are a short-term oriented investor,
Yeah.
now that frustrates you. But then if you give it for the long-term play, in the market we say in the long run, prices will follow the fundamental value.
Yeah. Hi, and welcome to another episode of Make Money, the podcast. And today we talk about the stock market. And just before I introduce my guest, I think I acquired some shares at some point this year, Wesley, and I'll make the introduction to yourself. And unfortunately, I'm down about 21%. And it's funny in a market that has been, up around 15%, since the start of the year. And luckily, anyway, overall, as much as I might have my own feelings about the stock I got into turning, we've seen a better year to the last 10 years. But at the same time, the challenge that we've seen is that there's a sort of discontentment or, a challenging view of the stock market. And, speaking to people here and there, they'll tell you, maybe the outlook, or going back in hindsight about 10 years, there haven't been quite the enthusiasm for investing in the stock market, mostly because of the many challenges we've seen. We've not seen any new listings coming on board. We've also not seen a lot of perhaps good news coming from the stock market. It's foreigners exiting, it's some companies delisting and exiting the stage. And so then the question becomes, how can I still make money from the stock market? And I'll just introduce you, Mr. Wesley. So Wesley Manambo is a senior associate research. I think I'll let you tackle the role you hold. Wesley, welcome to the podcast.
Thank you for having me, Kepha.
Yeah, and I tried best to set the context of where we're coming from and where we stand now. So it's a much better 2024 to say even the last 10 years. So we can even write off the last 10 years and say 2024 has been a positive year. So on average, about 15% up. What do you feel has been the difference this year to the gloom that we are talking about going back a decade?
Well, first you have to look at it contextually. When we draw closer to the last 5 years, a lot has been happening. I mean, look at 2019, there was a global slowdown, 2020, all the way to 2023. We had a pandemic, adjusting to the new normal, we had geopolitical tensions, and in a way, it kind of channels the investment style of investors, in that when there is higher uncertainty, they chase liquidity. So it ends up punishing price values, which is not sometimes in line with the fundamental view, or rather the worthiness of the underlying company. Yeah. So when you look at it from that perspective, the last 5 years, it has been a falling knife. And mythically they say, don't catch a falling knife unless you want to be... Exactly.
Yeah.
So when you look at it from that perspective, 2024 is a much better year, because we have gotten to a point where the knife is almost at the ground, in a sense, so to speak. So 2020 valuations were still better, prices at a discount, but then the story was buy the dips. 2021 buy the dips, 22 buy the dips, but the dips were still dipping.
Yeah. So it was your knife. Typically, you're still getting cut.
Getting the stocks early into the year, and you're 21% down. The dip still dipping. Yeah. But the best way to look at it is there value in the investment that you're making? Because at the end of the day, price levels are just back towards the value proposition, towards the fundamental mean. And then drawing into your question on what makes 2024 different. Yeah. First, unlike in the last 5-year period, we have had vote of confidence from international watchers. The MSCI they really added into, I think there were two companies,
Yeah.
Coop Bank and KCB, they added into the Frontier Market Index.
Yeah.
And there was BAT, Kengen, Kenya Re, and DTB added to the Frontier Market Small Cap. So in a way, it's kind of giving a vote of confidence to the market for external watchers.
Yeah.
So
yeah.
you expect to see more activity going forward.
Mhm.
Globally speaking, there is a lowering of opportunity cost.
Yeah.
And when you look at it from the perspective of, I don't want to be technical, but in the calculation of the cost of equity, which shows you what you if you make this investment,
Yeah.
what percentage are you losing by not making it, or rather, what percentage should another investment be more attractive than this one? And in calculation of that cost of equity, the opportunity cost, there is the risk-free rate.
Yeah.
And majorly you use the benchmark monetary policy. Globally, it's coming down,
Yeah.
with the US cutting 50 basis points in a rather not surprise move, but some analysts will argue it's not well calculated given the geopolitical environment. Gold
Yeah.
is speaking a different language altogether.
Yeah.
But then the lowering of the risk-free rate is making frontier markets and equity and emerging markets more attractive.
Yeah.
I mean, the day after the Fed cut the rates, when you look at what was happening with emerging market equities in Asia, they were all rallying because now investors were unwinding their position in US FIs, shorting them and taking their capital towards equity in that first move advantage in some sort to
Yeah.
take advantage before the rest of the pack comes in.
Yeah.
So we expect that to really come into 2024. And early into the year when we sat down, that was something that we were anticipating. Some investors picked that and started getting into the position early enough to get the lowest of the likely lows, kind
Yeah.
of to speak the trough of the market.
Yeah.
So that in a way has driven 2024 to the almost 15-16% from the benchmark index high.
Yeah.
So that is key in a contextual perspective.
Mhm.
Again, we've had some interesting it has been an interesting year. We've seen a cement manufacturer getting a takeover offer,
Yeah.
sending the prices off the roof. That was impressive. We've seen a bank that was trading at book values at a discount of almost 0.4-0.5. That's
Yeah.
I&M.
Yeah.
Having a block trade of about 10.13% of its outstanding shareholding, with key investors really transacting at that level.
Yeah.
That was really interesting. Again, banking sector bringing in very solid results, and the key blue chips mainly remaining fundamentally stable
Yeah.
at a perpetuity level. I mean, these are companies, as a going concern, you expect them to remain with very at a cash position that is attractive and very good valuation metrics, but that's not reflecting on the price.
All right.
Yeah.
Yeah. And I think speaking of the falling knives, and it's good to note, once the share prices are falling and you're buying into that, you end up, a knife falls and you end up cutting.
Yeah.
For someone listening, they might not see me try and make the impression of it. But basically, you catch a falling knife and it cuts through you, and that's what we've seen. I think I like that you mentioned the last 5 years. You thought it was the lowest it could get.
Yeah.
It gets lower, and somehow you end up hurt, or starting again from you almost start you almost push lower in terms of your
Almost in the
return.
negatives.
Yeah, almost in the negatives. They're now looking at 2024. We spoke about being 15% higher to where we closed last year. And, a feeling that now the knives have stopped falling in a sense. So we are at, you've mentioned the trough, basically the bottom of the stock market. Is it fair to say that now we are beginning to rise again? And I know we like mostly to draw around the phrases bulls and bears. And just for some context, the bull is indicative of the direction of the stock market. When a bull attacks you,
It lifts
you up.
Yeah.
And that's the bull. But we've been largely been a bear where, the bear comes down at you.
Mm-hmm.
And that's how the stock prices have been behaving over the last 10 years. So just another way. Sorry for someone listening. I know they won't be able to see our best impressions of bulls and bears here. But are we now in the bull? Is it time for the bull to lift us all up? Myself at 20% down on my portfolio, and others who are maybe better off in a sense. Are we beginning now to see the lift? Have we gotten to a place where we can say with certainty that it's no longer a falling knife? That's in some sense now we are beginning to move higher from, the historical, the decade, the last 5 years you are speaking about.
Yeah, by leading indicators, it shows that we are getting into a bull market. I mean, there is some sense of stability in terms of outflows from the foreigners. I think year to date it's about 8 million net inflow, which is big compared to what has been happening with very outsized outflows over the first 5-year period. So that as a leading indicator is key. Second, when you get into a bull market, it's quite an interesting place to observe, because you find investors are still watching each other. The buyers and the sellers are timing each other.
Yeah.
And you find key investors who are heavy in terms of capital, they tend to stay out of it until there is some sense of direction. Now when it's all green and prices are now climbing, that's when they join the bandwagon. So we're already on the early stages of the bull market. I see no reason to, at least from the data that we're seeing globally, unless a black swan event really comes in.
And another pandemic
swan,
in a
exactly.
sense.
And the black swan came from the study of birds.
Yeah.
The guy who, I think in ancient Europe, they believed all swans were white. Until one guy went to Australia and saw one black swan.
Yeah.
So black swan
is
is
quite
that
rare,
one thing that changes your whole perspective of everything rather.
Yeah.
So unless we get such an event coming in, because there's still a lot of tension geopolitically. I mean, when you look at what's happening in Russia, Ukraine is still around here.
Yeah, I think the Middle East keeps heating up.
Exactly.
Yeah.
And there's something that people are forgetting. China, Taiwan is still a worry for the medium term.
Yeah.
I mean, there's no escalation, but then there's a lot of tension in that region too. And when you look at China, I mean, it's the global manufacturing hub.
Yeah.
Almost all products are coming in from China. I think it accounts to almost 25% of US imports, give or take a bit. Now, accounting for 25% of US import, dollar is the reserve currency.
Yeah.
So a small change in that market can cause a butterfly effect to all other players and all other markets in a sense.
Yeah.
So still, unless we see as it holds, I think in Latin they say ceteris paribus, to mean all factors held constant.
Yeah.
So if all factors remain constant, we are really getting into a very interesting bull market.
Yeah. Yeah.
We'll see a lot of recovery because
Yeah.
an interesting thing is most of the companies that are trading below their fundamental value over the 5-year period, they're more valuable now than then. So we might see even new highs in a sense. So positioning yourself for a value perspective might have you really profit in the long run.
Yeah. I think we've comprehensively touched on 2024 and where we stand today. I'd like to take you back to the last 10 years where it's not been encouraging. Like I mentioned in my introduction, we've not seen any new listings for our stock market here, the Nairobi Securities Exchange. At the same time also, we've seen what has happened to the valuation, the falling knife perspective. If you look at it from price, it's been down considerably right around 2015 down. You could argue now we are heading well into the 10th year, at least 2024 being positive, that will break that run. But almost 8-9 years of falling share prices, and this has quite discouraged especially retail investor from a retail investor perspective. And again, I think another indicator, there's a story we did here around, at the business day around idle accounts where, you have almost all trading accounts or all, we call them CDSE accounts, almost idle and inactive in a sense. So no transaction was recorded, for the past year with that. And do you feel the pessimism around that where, people no longer feel like the stock market is a place for wealth creation, because of what has happened in the last 10 years? But then again, if we go back, say, we stretch it out to 20 years, then you will see this period where Safaricom came into the market. We had listing of the likes of a cooperative bank. I think also Equity came to market by introduction around the same time. We've stepped away from those glory days where, I like telling some of my colleagues that it's like the dinosaur story. Sometimes when I hear about the glory days of our stock market, it's like the dinosaur story. Yeah. I never saw the dinosaur. Sometimes some facts are presented, you almost doubt, did the dinosaurs really exist? Was there an asteroid that actually took them out in a sense? Now, taking that and putting it now together with the last 10 years where it's been the direct opposite, where people don't want to come into the market, people rather stay off. We rather play our MMF and fixed income games and just stay out of the stock market. Do you feel is it a fair reflection in a sense, or have we lost perhaps some sense of some value still underlying in the stock market? Because most people are like, tell me about money market funds, tell me about bonds. I don't know about these shares. I always see the market is down, the foreigner is coming, exiting again. The pandemics are happening, geopolitical risks, or the government is borrowing too much and paying a premium, so I might as well just collect that and not risk it in the stock market. Where do you sit with this? Is it a fair reflection of things in a sense?
I feel it's a half reflection because, there's two kinds of return in the market.
Mm-hmm.
There is the dividend return and there is the capital gains return.
Yeah.
Together, it gives you a total return. When you look at it from a total return perspective, it points to where our market is. Look at most investors. You mentioned that accounts remaining dormant for a lengthened period of time.
Yeah.
And it speaks to the nature of underlying investors. Most investors are in for dividends, and you find investors in for dividends are more of long-term investors. They just get their shareholding, hold it for a period of 5, 6, 7 years without disposing.
Yeah.
Even at double or triple capital price levels, they won't exit.
Mm-hmm.
I remember looking at BAT back in 2013. I think I was still in high school.
Yeah.
Looking at BAT at 1,000, and I thought, this is the best time to exit.
Yeah.
But when you look at the key shareholding structure, it didn't change that much.
Mm-hmm.
Because most investors are in for the dividend play,
Yeah.
the regular earnings.
Yeah.
So when you look at it from that perspective, the market has been vibrant from a dividend play, and even that's what it's making it attractive for foreign investors.
Yeah.
But then for retailers, you'd find most of them, that's you and me. Most of us are interested in how is our portfolio looking like. Is it 25% down, 6% up? Should I exit? Should I buy more? Should I sell less? And you find in that buy and sell, you lock in gains. You get transaction costs.
Yeah.
You lock in some losses. You
Then the
exit
transaction lives in even a sharper loss in a sense.
Exactly. And in that sense of chasing price, when you net down the overall effect, that's why you hear people saying, the stock market is not a place to make money.
Yeah.
But for people who are strategic, the people with outsized returns that, unlike fixed income, as the name suggests, it's fixed.
It's
income.
fixed, yeah.
You
It won't go beyond a certain point.
15% return in coupons, that's what you're getting.
Mm-hmm.
But then with stock market, it's quite interesting because if you look at the dividend policy of a stock, let's say they pay 80% of their earnings in dividends.
Yeah.
That's kind of fixed for as long as the top line remains attractive and cost environments, rather the operating environments remain the same.
Yeah.
But then from a capital play, you can unlock very outsized gains.
Yeah.
So you find that's the interesting bit because there's an aspect of, okay, we say there's no guarantee. The only sure things in life are taxes and death.
Yeah.
But then, in some sense, in the stock market, that's where it comes alive because the guarantee, if you do your homework right and get fundamentally sane companies where you're sure these companies, their growth to perpetuity is kind of guaranteed in some sense, or rather, the probability is higher. The likelihood of them existing in the next 15 years is quite high given the data that we have presently and the past performance.
Yeah.
So when you look yourself with such companies and you look at your total returns over a period of time, prices might be down. You might be down 21% on a price perspective, but then when you do the total return, it leads to a positive. And you find that's what the likes of institutional investors and high net worth investors, foreign investors look at, the total return perspective. So from that perspective, total return, it's still a vibrant market because look at it in terms of value. Companies sometimes are taken private. And they're taken private at very interesting multiples. So you find that exit value might be, let's say, 200%, 300%. If you hold that company over a period of, let's say, 4 years or 6 years, you'd find if you annualize that 300%, that's equal to making 50% annually from that exit value. And that's what most people don't look at it. They just look at it from a narrow perspective. But when you go broad and look at it from the bird's eye view, the market is still very, very
An explanation kind of segues to the next question I had. Are we then price obsessed as individual investors that sometimes I'm like, let's take case in point Safaricom. Maybe I got in at Safaricom around 18 shillings, 19 shillings. I've gone back to around now, I think, trading around 15 shillings. So I'm down 4 shillings. Are we very much price obsessed that we forget to look at, the dividend this stock is earning over time? And, this is still a growth company. They're still expanding in Ethiopia. There's much potential down the line. But maybe sometimes are we either obsessed or sometimes are we blinded by the price movements? Because anyway, prices go up and down, unfortunately, and they will always do that. But sometimes you get the sense that a lot of us are quite price obsessed, so that if I got in at 20 and I'm down at 15, I'm already giving up on that investment. I'm almost thinking of cutting my losses from just the price perspective. I've not looked at the trajectory of the performance of that company. I've not even looked at the dividend play in terms of how much dividend that stock is paying me, and also the opportunities to buy more at a lower cost. And I think the other example is what I think we discussed earlier before having these conversations. If today you told me, let's drop an example here. Let's say Kepha is offering 50% discounts on maybe a blend I've been looking at. I know those things are quite expensive now. Say now I'm getting it at 10,000 instead of 20,000. For sure I would be looking to buy. And if I can even flip it and buy a couple more and sell them on for even 15 and make a profit, then that would be the opportunity here. In terms of the stock market, we see the opposite. Prices fall and many of us tend to flee instead of
I love the example you've given of Kepha.
Yeah,
and that's how you should look at investments. Really, it's an underlying. Rather, it's an asset. You go see a TV, it was retailing for 80,000. Then there's a flash sale. They cut it down to 32,000. I mean, some of us, including myself, I think if I'm not liquid enough, I'll go look for a soft loan and get a TV. In as much as I'm not a TV person, you'd find the main reason I'll go buy, in as much as I'm not a TV person, it's because of that value proposition. And when you come into the stock market, that's what sophisticated investors do. They look at a company. Let me just case in study the bank you're talking about earlier, INB, trading at a book value of 0.4, 0.5. That's a discount of almost 0.6. You're buying it at 60% cheaper than it's actually worth. I mean, even if the price does not reflect it, that's a really, really good deal. It's almost too good to be true. And in sometimes, though rare, there's something we call value trap, where you get something that is giving you a very good discount, but then unlocking it becomes the issue. And if you are a short-term oriented investor, now that frustrates you. But then if you give it for the long-term play, in the market we say, in the long run, prices will follow the fundamental value. So kind of focusing on this value, which brings me to the point that you've asked, are we price obsessed? I think all investors are price obsessed because price is a reflection of capital. Let's go into the US, across the pond. You'd see the Elon Musk deal, the pay deal, that really brought a lot of jitters into the market. It was price linked because investors at the end of the day, they just want to see where is my value, because that's the in a sense that's the indication of where you are from where you invested. So all investors are price.
So where is my money becomes the question. Where is my money? I put it in.
And even back at our investment shop, Standard Investment Bank, we have an annual tradition of doing pay reports where we look at what we pay, what shareholders pay, the executive committee. That's your CEO, your CFOs, certainly most certainly the CEOs. And look at it, what value do you derive from that in terms of share price, in terms of earnings, in terms of multiples? You find there's a high correlation with the book value in terms of multiple, but share price, that's where it becomes an issue. And at the end of the day, you'll find investors are still interested more in that share price reflection, because even value at the end of the day should be reflected on the share price. But then I feel, in as much as in all investors, in a sense, even there's something called behavioral finance, which is looking at finance from a psychological point of view. You're looking at
how will people react,
exactly,
how will people act,
the tendencies, that emotion. I think there's I don't know if it's a certain physicist, he said if electrons had emotions, then physics would have been much difficult. Now, looking at the market, there is the very, very easy things. I mean, look at value, buy value, sell it when it's at the best of positions. Don't
Yeah.
buy something that is overvalued. Very easy, basic thing. But then you put the human emotional aspect to it. Now you have to study that from a behavioral finance perspective. For instance, what will make people sell something valuable or buy something that is overvalued? You
Yeah.
know? So when you look at it from that perspective, price can be taken out of context. Number one, how do you put price in context? Look at value, look at strategy, look at the market share.
Yeah.
Do you consume the good that company sells? You
Yeah.
don't have to consume it in the first place, but how is it selling out there?
Yeah.
Does it have a good reputation?
Mm-hmm.
10 years down the line, holding all factors constant, do you expect that company to be there?
Yeah.
There are those value, those strategic or broad view things.
Yeah.
Then you come down and look, okay, this is a good business. It
Yeah.
seems to have a good market share. How is it in terms of its cash flow? Because at the end of the day, we live in a capitalistic economy and capitalistic capital. Money is key. How is it in terms of money? Is it a money machine? Money in, money out, what's the net? Is it positive? Is it something that is growing that will pay me back in terms of dividends? And if at a point in time I want to sell, there's someone who will want to buy it at an even better price.
Yeah.
What we saw with I&M, though, off market they bought it at almost 48.42. The transaction of 10.13% shareholding. Well, the share price was almost at 21.
Yeah.
So you'd find that investor, though an institutional investor, almost unlocked double of where the share price was.
Yeah.
Because they were looking at value.
Mm-hmm.
So price with value is price in perspective, in a sense.
Yeah. So unfortunately, it's most of the time we had is spent here, and maybe the final question to put a wrap to this is for someone listening and wondering. There's quite a lot to look at, and you have to get quite analytical with the stock market. But from where you sit is you can still make money from the stock market in a sense. Then how do we go about now? How do you strategize? Do we go short term? Do we go long term? Do I decide if today I get in, I'm giving it 5 years, I've seen potential, this company will be around, this company is expanding. How can one still make money from the stock market, no matter where the movements of the market are? Because we report on that, we'll have the headlines. This year could be up, like we said, 15%. We might close even higher than that.
Yeah.
Next year could be lower depending on what happens. How can a person still, create value, generate wealth from the stock market, no matter whether we are, the bulls we are talking about, we are all being lifted, or the bear is coming down on us? How do you navigate that to ensure that you are still making money? Do you go then quite long term in view in terms of 10, 20 years? Or are there still strategies that can keep me, 6 months, 8 months, I can still, generate my value? If so, I think, or where's your bias towards investing in the stock market? Do we think short or long term?
Our story is told of Safaricom.
Yeah.
It came in at an IPO, I believe, 5 shillings.
Yeah, 5
per share.
shillings.
Then it rallied to 7 shillings. That was an easy 2 shillings. People got out.
Yeah.
I think just before Russia-Ukraine, when they got into Ethiopia, the share price was at 45. Now imagine that investor who got in at IPO at 5 shillings and decided to exit at 45.
Yeah.
That's an interesting investment story.
Mm-hmm.
I always say it's best to go long term.
Yeah.
Have a long-term perspective, but if opportunities that favor you come in the short term, exploit them.
Mm-hmm. Mm-hmm.
Case in point, we know bears and bulls are circular movements.
Yeah.
After bull market, you expect a bear. After bear, bull.
Yeah.
It's a non-cycle that has been there when you look at even more mature markets like the US, when you look back to the likes of the Doe. There were Charles Doe. I believe that's the name of the guy.
Yeah. That's the name of the guy. Yeah.
He came up with a very interesting theory of primary movements, secondary movements, with data running back to the edge of the railroads when they were trading in the market.
Yeah.
And those are circular movements, So when you position yourself there, you'd realize now with this psychology of investors, bringing it into perspective.
Yeah.
When you're in bear markets, people tend to be risk off.
Yeah.
They keep off the markets. Sellers don't want to sell to lock in their losses. Buyers don't want to come in because they are not sure. And most of the time, fixed income is offering you something that is fixed and you're certain.
And guaranteed, yeah.
But then when you come into the bull market, now that's when people are awash with liquidity. bank rates are lower. You can now finance your mortgage with your house with a loan, rather than paying full for your car. Just finance it with a loan. Then you're left with a lot of money. You'd be willing to buy a stock that is trading at 1.1 book value. That's a premium. You're paying a premium, but you have the money. You just want to get in. So in bull cycles, people are often more inclined to buy at any given price. There's a lot of optimism, so to speak.
So that's the market will always go up. And
exactly.
You
so
can get in.
Investors who invest in bear cycles and exit in bull cycles, I think they have a different story to tell. It's a very profitable strategy that works. But then, long story short, long-term perspective and taking advantage of short-term opportunities when they align themselves, I think it's a winning strategy.
And I think just to close it off, you spoke of Safaricom. There are guys who got in at 5, exited at 45. The opportunity offered itself. But unfortunately, there are people who got in at 45 and you can tell where they are now.
Reminds me of
so quite,
Peter Lynch.
But yourself as a person, not any investment advice per se, but where do you see it? Short term, long term? Where would you see it yourself?
It's a long-term market. I'd borrow 2 quotes from Peter Lynch, one of the greatest money managers we've had globally. He said, don't buy cheap stocks just because they're cheap. Buy them because the fundamentals are improving. Stocks do well for a reason and do poorly for a reason. Make sure you know that reason. Second, he said, stocks are not lottery tickets. There are companies behind every stock. If the company does well, then certainly the stock will do well. So you find beyond price, just sit back and say, what's the value of this company in the first place? Because even if the price does not unlock that value, then you're sitting yourself with a very valuable asset. Just like land. I mean, the people you'd find they have land in CBD, but then they are dead broke. But then they're sitting on a very, very lucrative asset. They can decide to monetize it or just sit with it, and it just gives you some very good net worth calculations, because it's something that has great value underneath. So looking at it from value then pricing, it's always a winning strategy in my view.
All right. Thanks. That's all the time we had for Mr. Wesley. So thanks again for being on the podcast, and we look forward to having more conversation around the stock market. I'm sure there are still unanswered questions, and this is all the time we had for, but I'd like to thank you very much. And that has been Wesley Manambo, Senior Research Associate at Standard Investment Bank. And this has been another episode of Make Money, the podcast. Remember to catch us at businessdailyafrica.com, nation.africa also, and across any other place that you get your podcast. Catch you next time on the Make Money podcast.